Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Rodrigo Gordillo, President and Portfolio Manager of Resolve Asset Management. We are talking about return stacking and return stacked ETFs. So return stacking, also known as portable alpha, has been employed by institutions for a long time. And it basically involves using leverage to enhance overall returns and add diversification benefits to a portfolio. But this sophisticated strategy was generally out of reach for retail investors. And now, thanks to ETFs, these complex, sophisticated strategies are becoming accessible to ordinary investors as well. And Resolve now has a suite of 5 return stacked ETFs. Their flagship fund, RSST, which is just a little over a year old, has already gathered over 220 million, and their suite now exceeds 750 million in AUM. Rodrigo, welcome. Great to have you with us today.
Thank you for having me, Neena.
So let's start with the basic question. What is return stacking? Please explain to a layperson.
Sure. As you mentioned, return stacking is a new name to an old concept. But just to kind of make it simple, the versions of return stacking that we're putting together tend to be the idea of layering one investment return on top of another so that we can achieve more than $1 of exposure for each dollar invested. So if you give us $1, we're going to give you $2 of exposure. But importantly, that second dollar tends to be a non-correlated either asset class or alternative investment strategy that helps with diversification.
Awesome. Now, let's talk about the potential benefits as well. Talk about the investment case for return stacking.
Sure. I think that the idea here is by being able to unlock these prepackaged solutions, unlock this diversification, it really does allow investors to maintain their core and stock bond exposure while at the same time introducing new diversifying return streams, right? Because if you think about the history of adding diversifiers to your own portfolio, if you're an investment advisor to their client's portfolio, it's been quite treacherous, especially when your favorite toys, your favorite domestic equity markets have been the best performing asset class, right? So if you ever tried to add diversification through any sort of non-correlated alternative strategy, it was an exercise in addition via subtraction. You had to sell things that you really liked in order to buy things that you weren't quite sure of. And the hurdles for those alternative sleeves were very difficult, right? The hurdle needed to be positive returns most years, sure. But more importantly, they needed to be, from a behavioral perspective, they needed to outperform the base benchmark of the core portfolio more often than they did. And so if you have something that's non-correlated, true alpha, but has a volatility profile of 5% and a return profile of 5%, when the S&P is annualizing at 10, that's going to be a tough hold. So the concept here is to say, instead of addition by subtraction, why don't we go ahead and do a yes and solution where we can say to people, yes, keep your equity and bond portfolio and stack these diversifiers on top. And so the way this would work practically is you would say, let's say you had an investment product that was for every dollar you bought, it's $1 of the S&P and another $1 of liquid alternative. Well, you could sell 10% of your S&P 500 portfolio, buy this product that gives you your S&P 500 exposure right back. But when you put your X-ray goggles on, you're getting an additional 10% stack of this diversifier, in essence, stacking the returns of those diversifiers on top of your whole portfolio. And that way, at the end of the year, if that alternative strategy or that stack that you decided to add it was positive, whether it was a little bit positive or a lot positive, you would get your benchmark portfolio plus that excess return. And that's what really that's really the use case. And again, this is something that started, like, as you mentioned, back in the 80s. PIMCO started, one of the longest running return stacked funds was the PIMCO Stock Plus Fund, where they realized that they could provide people with the S&P 500 return while also stacking their bond picks on top. So they would buy their bonds, their favorite bonds, and they would use an S&P 500 futures contract and layer that on top to get another 100% exposure. And if you look at the public data for that fund, the ticker's PSLDX, you see that when you look at the return since August 2007, which is where the public data that I found was, they've annualized at just under 14%. The S&P has annualized at just around 10 during that period. Long duration bonds around 4, cost to borrow around 0.8. You add those up, you come in at around the same return as PSLDX. So we don't have to look far to realize how valuable a stack like that could be. And this is really where alpha beta separation came in. Institutions started using it, and but it wasn't available for retail in a very clear and concise way, I think, up until we started really putting pieces together, educating and talking about it.
Now let's talk about the risk, because investors will wonder whether return stacking results in stacking of risks too. And there was an article on Bloomberg.com recently. The title was "Levered Trade That Blew Up in 2008 Gets a $600 million ETF Redo." And this article talked about your ETFs, and investors remember that long-term capital management, Lehman Brothers, they had all imploded because of excessive leverage. So please tell us what happened during the financial crisis and what's different now.
Yeah, and I think that's a very important time to shine a light on, because there is, if you look at the history of financial blowups, almost all of them that really make the headlines are around the use of concentrated leverage, right? So that is the death knell of most of these things. And it also is what tended to happen in 2008, right? So I mentioned earlier that the idea of portable alpha is that you grab your base portfolio that you like, and then you stack something that's different on top, right? An alpha meaning that it should have zero correlation, very low correlation to the thing that you're stacking on top, ideally. And the reality of what happened in 2008, and of course, you never know who's naked until the tide goes out, as Warren Buffett says all the time. What happened in 2008 is that people were using leverage in order to get more exposures to things that they liked. But what they liked, these hedge funds that they were using, were actually just more long of the same things. So they were levering up more risk assets than I think the underlying users either inadvertently or explicitly decided to do. So when you have more than 100% exposure to equity markets and the equity markets go down, you're going to go down what the equity markets did plus more. And broadly speaking, that's how the implementation of portable alpha, there was a lot of lessons, hard lessons learned. A lot of people got burned. And the recognition is that if you're going to use this, you better be sure that you're that you should be stacking things that are going to actually mitigate losses rather than exacerbate them. And so the first few stacks that we have launched are designed explicitly for that. If you look at the landscape of alternative strategies that one can stack on top of equities and bonds, the ones that we have selected are the ones that, when you look at the correlation history of these strategies across the board, they tend to have the lowest correlation to equities and bonds, and have the historically proven to actually provide really strong positive returns during prolonged both equity and bond bear markets, right? So if you can imagine, now you're stacking something that helps you reduce your maximum peak to trough loss of your beta portfolio. All of a sudden, this concept of portable alpha plus diversification makes a lot of sense.
Yes, and since you mentioned Warren Buffett, arguably the greatest investor of all time. I just wanted to add that he has used low-cost leverage in Berkshire as well. And in fact, he has said that this has given Berkshire quite an edge over their competitors. So now let's take the example of your flagship fund, RSST. And could you walk us through the investment strategy, what exactly it holds, and how is the strategy achieved?
Sure. Yeah. So RSST is basically for every dollar that you give us on that ETF, you're going to get a full dollar of US large cap equities. And then you're going to get another full dollar of an exposure to a managed futures trend strategy. Okay. So for 100% exposure to the S&P large cap, that's the US equity large cap, and 100% exposure to a managed futures trend strategy. Now, why is managed futures the first alternative strategy that we clung on to? Managed futures trend in particular. Well, it's kind of in the name, right? Trend following has been around again for decades. If you go back to the turtle traders of the 80s, these were individuals that were trading not just equities, right? Because I think a lot of people think about liquid alternatives as choosing the best stocks and then shorting the worst stocks. But in the future space, what you tend to have is a very, very well diversified, broad market that includes all of the global equity indices, all of the major bond indices, all of the major currencies, as well as all of the major commodities. And so you have this broad basket of securities to choose from, and futures allows you to very easily go long and short all of those markets. And the turtle traders were just looking at trends. They were looking at charts and seeing if the trend was up. They recognized that they were likely to continue to be up over the next period. And if trends were down, they were likely to continue to be down over the next period. And if they were diversified across their bets and were updating their bets every single day, then they saw that they got returns that were upward sloping over long periods of time and had very low correlation to equities and bonds. And in particular, when trends are really robust, when the trends are most obvious and they're prolonged, weeks and months long, you tend to have the best outcomes for a managed futures trend. It makes sense intuitively if you're following trends, right? The longer the trend, the more persistent, the more money you're going to make in a trend strategy. And guess what? When do those very strong trends tend to arise? During periods of duress or periods of euphoria, right? Periods of duress like the tech bubble burst in 2000, 2003, or the credit crisis of 2008, or 2022, the Ukraine war and the inflation boom there, and periods of euphoria like 1999, where you had a massive influx of liquidity and the tech bubble really providing some magical returns there as well, right? So because of that characteristic, it tends to do its best when your core portfolios tend to do their worst. And so that's the benefit of tacking on something like trend strategy as a stack. Now, why don't people use this as just an addition by subtraction to their portfolio? Because one of the drawbacks of managed futures trend following is that most of the returns come at the tails, come at those big events. And then you get modest returns most other years, right? So when you're competing against consistent 8 to 15% returns on a calendar year basis with the S&P 500 versus something that's giving you 2, 3, 4% most years, and then a big double digit 20, 30% in the best years, but most years you're getting hurt, it feels like you're losing most of the time when you're trying to make room in your portfolio. But when you stack this on top and you're making an extra 1, 2, 3% in moderate years, that is a ton of value that you're able to add to the portfolio. And because of the non-correlation, you're stacking those returns, but not necessarily stacking those risks. So that's kind of like the high level. And then from a specifics perspective, the pros and cons of this is in 2008. So if you look at something like the SocGen Trend Index, which is an index that goes back to 2000 that follows this space, you find that in 2008, it was up 20.9%. In 2022, it was up 27.4%. And then as those big, abrupt, kind of prolonged bear markets fade, they tend to give some of that back. So in 2009, it was down 4.8%. In 2023, after the 2022 big year, it was down 4.2, right? So there is some give back there that is non-correlated to equities. And so there is certainly behavioral hurdles that need to be dealt with. And by stacking, I think we do a good job of reducing those hurdles.
Yeah, I recall 2022, which was a very challenging year for investors because most major asset classes had a terrible performance, stocks, bonds, everything. And one area that managed to shine in 2022 was managed futures. So DBMF, an ETF which invests in managed futures, was up over 30% then. Yeah. And our listeners will recall that we had Andrew Bear on the show then. You mentioned longer term performance of these strategies. So I just wanted to discuss the performance of RSST so far as well. So I looked at the performance. It is, since inception, it is up about 18%, whereas the S&P 500 index is up about 27% during this period. So is RSST performing like it is supposed to perform? And should investors compare the performance to stocks or to a 60-40 blend of equities and bonds? Or should they not look at the short-term performance at all, because these strategies, the aim of these strategies is a smoother ride over a longer period, or they should see these as insurance against bear markets, which you also mentioned. So could you talk about how investors should look at the performance?
Yeah, so the ETF is I think we just ticked over a year. And the way they should, if they want to see exactly the components, they can just add the S&P 500 return, and they can look at the return of the managed future space, and you can look at it, Morningstar Index or the SocGen Trend Index, add those two up and see how it's done. And as I mentioned, 2022 was great for that space. 2023 and a little bit of this year has not been great. And so that differential is the fact that managed futures trend as a whole has had, I think, between 8 and 10% loss since we launched, right? So it's just an unfortunate launch period. Had we done it a year before, or you can just look at any one of the managed futures managers, and you'll see the benefits of having that in your portfolio. When you look at the history of the index, you're looking at 8 out of 10 years, the index tends to provide positive returns. 2 out of 10 years, negative returns. So some years you're going to stack positively. Most years you're going to stack positively if history is any indication, and a few years you're not. And we happen to be in a year that we're not. Now, are people buying 100% of their portfolio in this? No, right? The goal here, when we look at advisors and investors, is especially a starting position of 20%, means that if you're a 100% equity investor and you've just stacked, you sold 20% of your equities and replaced it with RSST, then that 20% since inception is underperforming. By your portfolio as a whole would be underperforming by around 2%. So it's not the end of the world. But as time goes by, if we do continue to get those 8 out of 10 years positive, you'll end up over time stacking in a positive way. And so, one of the key use cases here for Portable Alpha historically has been, how do we beat our benchmark over time if stock picking is really, really tough? And I think an answer to that could be you stack non-correlated strategies on top. And if they, on average, perform positively, then you are, on average, going to be able to outperform your benchmark. And then how much of that outperformance you want, or how different you want to be from your benchmark, will be defined by how big a stack do you put into your portfolio. Is it 10, 20, 30, 40, 50? That's where it becomes, a very personal matter.
Right. So whenever we talk about leverage in the ETF world, whenever we look at leverage ETFs, we talk about volatility drag as well. So the ups and downs of the market can hurt levered ETF a lot. So could you talk about the volatility drag on these ETFs, return stacked ETFs, and how you manage the volatility drag?
Yeah, so I mean, volatility drag is something that isn't just explicitly an issue for levered products. Volatility drag is a mathematical reality, a compounding reality that applies to any investment and involves any investment's volatility. So if you think about the S&P 500, from 2000 to now, I think the volatility is roughly 20% annualized standard deviation, right? That's the volatility. If you add up all of the calendar years and you average them out, you're going to get a number that's much higher than what your compound rate is. And that compound rate, the equation is the arithmetic return, so the simple addition of those years, minus half of the variance, right? So the higher the variance of a portfolio, the more it's going to eat into your average return. And so 20% volatility, if you have 10% return, and you have a lot of variance, you might eat up, let's say you subtract 5%, that's your compound rate of return. But what if you were able to create a portfolio with the same level of volatility, but double the return? Then the variance hasn't changed. The variance drag hasn't changed. And the geometric rate of return has gone up. When you look at 2x S&P 500, you're not just trying to double your return, your arithmetic return, but you're also doubling your variance. Does that make sense? That's the two times bulls ETFs that you see there. You're doubling the variance and doubling while you're trying to double the arithmetic return, meaning that the geometric return isn't 2x the non-levered version. Now, fast forward to return stacked. One of the key benefits of diversification is that you can increase the portfolio's return. This is finance 101, right? The idea that if you create a more efficient portfolio of asset classes that have positive expected returns, but zig when the other ones zag, it means that you can increase the return while not necessarily increasing risk. So when you look at the S&P 500 at 20% volatility, and then you stack on top a managed futures carry strategy, for example, with a 10% volatility, the addition of 20 plus 10 is 30. But because of the stack zigging when the other strategy zags, what we find is that the volatility of the combined 1 plus 1 is just over 20. It actually barely budges. It barely increases in risk. And so the volatility, the variance drag goes up a tiny bit, but by no means does it double. And that is the benefit of diversity. That's why concentrated leverage is not only a problem from catastrophic events, but it's also a problem from a return drag over time. If you're able to use leverage to increase returns but maintain volatility, then that's kind of the magic formula. And that is, that's William Sharpe's thesis and what won him the Nobel Prize. So it's nothing new.
Great explanation. So you have 5 ETFs. Currently, you offer 5 ETFs. We talked about RSST. Could you tell us a little bit about other ETFs in the suite as well? And how should investors pick and choose from these products?
We got 5 products. We have one that's very different than the other 4. So let me start with that one. The first one doesn't try to do anything fancy at all. It tries to kind of mimic what PIMCO had done before, but in even more simpler terms. It's for helping you create room in your portfolio for a couple of use cases. You can stack your own diversifiers, or you can create a cash buffer in your portfolio to use whenever you want. And so that first one is RSSB, return stack stocks and bonds. And that gives you 100% exposure to global equities and 100% exposure to a laddered treasury portfolio that has similar duration to a U.S. aggregate bond index with 6.5 years duration, right? So similar to what the average bond portfolio is for most Americans. And so you get a dollar of equities, a dollar of bonds. And the use case there is that you can say, look, I'm going to sell 10% of my equities, 10% of my bonds. I've raised $20 in cash. I'm only going to use half of that money I've raised to buy RSSB. Now I have that back. If I x-ray my portfolio, I got my equities back and I got my bonds back. I'm fully allocated. Plus I have $10 cash in there that I can just invest in T-bill. And then just sit there with it and wait for an opportunity for when the markets fall, and do a Warren Buffett approach where when there's blood on the streets, you can use that money to buy more. Or if you like a specific alternative manager that has made you positive returns for 15 years, but never beaten the S&P 500, this gives you an opportunity to keep that manager, but stack those returns on top. So that's the first kind of capital efficient ETF. Super simple, 40 basis points, 41 basis points, I think. The next four are, the base are either equity bases, US equity bases, or bond bases. So two of them have US equity exposure as their base, and two of them have US bond exposure as their base. And what we're stacking on top of one is managed futures trend following, which I went through in detail, on top of the S&P 500, that's the RSST. And then RSBT, bonds in trend, is aggregate US bond index plus managed futures trend, right? So that's kind of a coupling there. And then the next two is, again, S&P 500 with a managed futures yield strategy. And that's just the same markets as the trend strategy, but picking it in different ways. Instead of picking it based on trend, it's picking it based on the dividends, or in other words, the yield or the carry that each one of these ETFs, each one of these markets has at any given time. And it has zero correlation to equities, bonds, and very low correlation to trends. So it's a logical next thing to add to portfolios. It also has a tendency to do pretty well during bear markets. And so again, that one comes with a equity base plus the yield, RSSY, stocks and yield, and a bond base plus managed futures yield, which is RSBY. And those are the five for now.
Very interesting. So last question, how these products should be used in a portfolio. So let's take the example of a traditional 60-40 portfolio. Should investors sell some stocks or bonds to free up cash for these strategies if they want to consider?
I mean, the answer is yes, and it all depends on your personal circumstances, obviously, right? So if you're an investment advisor and you have a business that is mostly retirees, and you're worried about inflation and you're worried about bear markets, your portfolio is mostly going to be bonds, right? So it makes probably the most sense to sell some of your bond positions to buy some of the RSBY or RSBT ETFs in order to stack things that tend to do well in bear markets and inflation regimes, right? So that's a use case for using bonds. Then there's the other extreme, which is an advisor, an individual who's 100% equities and wants the opportunity to outperform those equities, wants to aim for that. They tried stock selection, hasn't gone well for them. Maybe stacking would be the way to go. They could use the RSST or RSSY to sell their equity positions, replace them with any one of these or both, ideally, because you get more diversity by using both trend and yield. And then you get to stack that on top. And if all goes as planned, then they get to, over time, have an opportunity to outperform the just plain vanilla S&P. So I think most investors were seeing the use case being precisely that. And then there's everything between, right? People that are 50-50 bond equity, they like the idea of selling some of their bonds, some of their equities, and using a combination of those exchange traded funds. And then for the capital efficient one, which is bonds plus equities, global equities, then it's kind of you choose your own adventure there as well. You just make room in your portfolio, sell 10% of your bonds, sell 10% of your equities, replace it with this, and then leave it in cash, use it for whatever you want. Maybe if you need to borrow money, that's another one, because you're borrowing at institutional rates with these ETFs. So instead of going to the bank and asking for a loan, you could either sell your portfolio, or you go to the bank and ask for a loan, or now you can sell 10% of your bonds, 10% of your equities in your portfolio, raise some money, replace it with its ETF, and whatever cash is left, you use for whatever you need to use, hopefully momentarily, while still maintaining your exposure to the markets at the most competitive rates that one can find, given that we're getting our borrow from futures contracts.
Excellent stuff, Rodrigo. We'll have to leave it there. Thank you so much for joining us today and for sharing your insights. And also congratulations on the success of return-stacked ETFs. It's pretty impressive.
Thank you, Nina. Really appreciate the time that you've given us. And if anybody wants to find any of these, you can go to returnstack.com, or you can also reach out to the principals. This is a joint venture between Resolve Asset Management and Newfound Research, so you can look us up. Corey Hofstein from Newfound has a great Twitter profile that does a lot of education on this stuff. So do follow us if you can.
That was Rodrigo Gordillo of Resolve Asset Management. Let's quickly recap the tickers. Their flagship fund is RSST, Return Stack US Stocks and Managed Futures. RSBT for Bonds and Managed Futures. RSSB for Global Stocks and Bonds. RSSY for US Stocks and Futures Yield. RSBY for Bonds and Futures Yield. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.